CFTC Commissioner Kristin Johnson is calling on Congress to modify several pieces of proposed digital asset legislation to expand the U.S. agency's authority to conduct due diligence on any firm seeking to purchase a minimum 10% share of the equity interest in a CFTC registered market participant. Joining us to discuss this is CFTC Commissioner Kristin Johnson. Welcome, Kristin.
Good morning. Thank you so much for having me.
Okay, it's great to have you here. There's been a lot going on, specifically with LedgerX and a lot of other things. But can you just break down a little bit some of the arguments that you've been making about, LedgerX specifically and the role of the CFTC?
Absolutely. In part, what I'd like to share is that we have a long-standing policy of engaging in a continuous dialogue with market participants and others who are not registered market participants who seek to acquire registrants in our markets. This is a critical line of dialogue, if you will, because it is through this communication that we are able to affirm the financial health and well-being of any entity that would become a parent company to an entity that is operating in our markets. And this is true across asset classes. So this is technology agnostic. It's not specific to crypto markets individually. It is really more about ensuring the safety and the soundness and stability of markets broadly. But we see it very sharply brought into focus in the context of LedgerX for several reasons. First, let's recall that it's just a couple of years ago that FTX, through West Realm Shires, acquired LedgerX. And in that acquisition, there was limited visibility into the parent company, FTX. There are many critics that are frustrated by regulators' failure to predict or foresee that FTX was a house of cards. But one of the biggest challenges in this context is, in fact, this very small but really important piece of regulation.
Okay, thank you for clarifying that. But can you explain a little bit about why this would be the role of the CFTC specifically? Because as we know, in the US, there's a lot of debate over what agency does what when it comes down to crypto.
This is fair. And there's, in fact, what I would suggest is under the Securities Act of 1933 and the Securities Exchange Act of 1934 and SEC-based regulation, and in connection with the bankruptcy code, the SEC has powers and authority. The FDIC, the Fed, other chartering financial market regulators have authority in certain contexts as relates to a party acquiring an entity that is registered in their markets. So this is about LedgerX because LedgerX is registered as a derivatives clearing organization, a DCM, and a swap execution facility with the CFTC. We are currently the regulator for this registered market participant. So this isn't a turf war. This isn't a battle. It really revolves around when a business makes the decision that it would like to be part of a particular financial market ecosystem. And in this context, it's the commodity derivatives ecosystem. As you well know, LedgerX has been facilitating retail market participation, fully collateralized in the spot market and in the context of commodity derivatives, Bitcoin futures. And so what I'd like to highlight here and emphasize is that here we have a market participant that has made a conscious decision to register and be part of the CFTC regulated ecosystem. And our ask, or my specific ask, I'm urging Congress and my fellow commissioners to be thoughtful about the necessity of ensuring that when a business outside of our ecosystem acquires a business within our registered to operate within our ecosystem, it's important for us to know certain facts, information, data about the company acquiring a registered market participant.
Commissioner Johnson, I'm going to ask this question as if I'm pushing back, and that's this: is that LedgerX pushback? It's not necessarily my thought here, but LedgerX survived FTX's collapse, and it did so. One would argue because they followed the rules of the CFTC. They followed all the registry. They kept everything clean, and they did whatever they had to do as they were a registered entity. It didn't matter who owned it. What about that argument that who cares who owns it as long as the entity itself that is registered abides by the rules and has the liquidity required, et cetera, et cetera? Why does it matter if it's owned by FTX or Binance or Kim Jong-un's retirement fund or whatever it is, as long as it gets to do what it needs to do?
So I think this is a fair question, and it really raises, I think, points that are part of a critical dialogue that we have to start to have around exactly what the contours of any intervention, particularly a legislative intervention, might be. I'd emphasize something you suggested, which is that LedgerX did in fact comply. That compliance is driven in part by our presenting to LedgerX conditions or obligations for the entity operating in our markets. In fact, it is helpful that we had a registrant who was focused on and thoughtful about acknowledging risk management, customer segregation of customer funds, financial resource requirements, setting aside reserves for in case of a rainy day, or more importantly, in case of a liquidity crisis. Those obligations that we imposed on LedgerX, you're right, they served their purpose. They were fit for purpose, and they were effective in effectuating or ensuring that customers' assets, customers' funds were accounted for, immediately available, even in the context of the parent company bankruptcy. But no one could dispute that FTX's bankruptcy is a significant disruption. It's not merely a disruption for LedgerX, one of the many subsidiaries owned by the parent company, but it's a really significant market disruption. I would go toe-to-toe with anyone who would suggest otherwise. I also believe that the ripple effects, not just of the FTX bankruptcy, but of the broader daisy chain of crypto firm collapses over the course of the latter part of the spring and summer and fall of 2022. So here I'm referring to Terra Luna coming unpegged from the US dollar. I'm thoughtful about Three Arrows Capital, Voyager, Celsius, FTX ultimately in BlockFi, and then most recently, the crypto lending arm of Genesis. What we have to be focused on is this disruption is really problematic for all market participants operating in this ecosystem. Now, it might be complicated for others to impact counterparties for trading purposes, or others who are operating in the ecosystem, but it's really possible for us to look up to the parent and say, we'd like to know with certainty that you will grant representations, warranties, that you will covenant to ensure that the company that you own will abide by our regulations, and that in the event this company experiences a liquidity or solvency crisis, you are prepared to help this firm navigate through the bankruptcy process, unwind, or perhaps extend lines of credit, which is often more common the role of the parent to the subsidiary. It's important here to think that there is a sacred tie, if you will, between the parent and the subsidiary. The parent is probably the most invested party in the success of the subsidiary. So it's important for us to have a relationship with the owner of any entity that is registered to operate in our markets. I'm going to go further here and say that a culture of compliance often begins at the top. And in the context of a business, that means setting up a chief risk officer, chief compliance officer, establishing a board of directors qualified, well-informed, and capable of necessary to avoid the corporate governance failures and risk management failures that there are rumors floating about suggesting happened at FTX. I think I'd suggest that culture is not solely part of what's happening in the subsidiary, but it's often influenced by what's happening in the parent. I think we're fortunate that no one reached into LedgerX's coffers and attempted to misuse customer funds in ways that we believe customer funds may have been misused in other parts of the ecosystem at FTX. But it doesn't mean we should rest on our laurels. We should not give up any ground. This is the time to double down on what we think are the most important values and regulations in our markets, and to reinforce those values and regulations in a full-throated way.
Are you confirming that misused funds was happening with LedgerX or the FTX US entity?
At this point, we are engaged in an enforcement investigation, and in the context of the ongoing investigation, I would refer you only to the court documents for facts regarding our enforcement division's enforcement action. I think the facts in that complaint speak for themselves. They outline a very clear, and articulate a very clear description of what the CFTC believes was occurring at FTX that is problematic in accordance with our statutory and regulatory framework. I won't divert from that because I believe our complaint among those that were filed was the most fulsome and articulated in the most clear and descriptive way the concerns we have regarding software code protocols and other mechanisms that allowed for backdoor reach-in to access customer funds.
So, Commissioner, some of the ways that the CFTC has suggested expanding oversight is conducting due diligence on any firm, foreign or domestic, seeking to purchase a minimum of 10% of a share of an equity interest in a CFTC-registered market participant, and allowing the CFTC to initiate a notice and comment process for proposed acquisitions. Are there other rules that you are suggesting?
So this is really critical, and I'd like to parse that out. First, I'd like to just emphasize that what I'm proposing is, at this point, the CFTC needs to engage in a dialogue with market participants to understand effectively how to modernize our regulation. It's not merely in the context of this one area. I think never letting a good crisis go to waste means we acknowledge the need to modernize regulation in several areas. I've talked about it in the context of the sale of a registered market participant. I've also talked about the need to modernize regulation in the context of thinking about intermediated versus disintermediated customer protections. In the intermediated space, where FCMs or broker-dealers often operate, facilitating transactions on behalf of clients, we have a plethora of regulations and statutory protections that ensure the separation or segregation of customer assets and provide for protections limiting the use of funds, requiring that the company that's operating as an FCM or broker-dealer have certain financial resources, cybersecurity safeguards, et cetera. In the context of non-intermediated trading, which is the type of trading that LedgerX is facilitating, we don't necessarily have those provisions or protections built in through statute and regulation. So I'm suggesting we need to have a very effective and thoughtful dialogue about how to modernize regulation and bring it into a place where it's fit for purpose in light of the evolution in our markets, the introduction of innovative financial and technology-oriented products. This is to get our house in order, if you will, at the CFTC, and to ensure that as markets evolve and as interest in using different market structures evolves, that we are effectively able to ensure or establish the same customer protections across the board, agnostic as to asset class, agnostic as to the platform on which you're trading.
Commissioner, speaking of non-intermediated entities, have you given some thought to DeFi? I mean, these FTX, other crypto lenders you mentioned, these are centralized entities. And there is a school of thought that truly decentralized DeFi platforms should be a garden that should be allowed to grow on their own, and they don't involve centralized intermediaries. So what are your thoughts on that?
So I have heard the theory of allowing 1,000 flowers to blossom. I think that's what you're referring to there. And the notion that we should distinguish between CeFi and DeFi platforms. On an intellectual level, as someone who is deeply interested in financial markets, history, and evolution, I think there's a lot to be said about that. As a regulator and wearing the hat I currently wear and sitting in my current seat, what I would share with you is the protections I'm advocating for really should be in place, no matter CeFi or DeFi, notwithstanding the protocol or API built on the protocol. The goal here is to ensure that if there are protections for customers in our markets in certain areas, we find a way to code those protections, to build those protections into any technology or with respect to any asset class that's operating in markets. So I'm going to give you a specific example. In the context of CeFi, I agree. The matchbook order or the process for matching buy and sell orders operates very differently, I understand, from sitting with folks at Uniswap or at other platforms that describe to me how DeFi protocols operate. I'm thrilled to have had that education. I had engaged in a deep dive research project exploring this very question ahead of being confirmed as a commissioner. And so I acknowledge and appreciate that there are infrastructure differences, operational differences that merit acknowledgement regarding these two different approaches to facilitating trading and settlement processes or matching buy-sell orders. At the same time, I think it's important not to mistake what technology is doing or can do with what we aspire to have it do at some point in the future. So the cybersecurity system safeguards that I mentioned a moment ago, those cybersecurity system safeguards, those customer protections, if they are built in effectively, maybe it's engineering through coding, perhaps it's a different approach, but if those protections are built in, that is the really critical question we have to be focused on. It isn't that if we take a particular tact in crypto markets, we can avoid the need to think about this, or we don't have to worry about this. I think that's one of my gravest concerns about this nascent area of financial markets. It's that all too often folks want to disregard or discard all of our learning from all of the crises that we have witnessed in markets to date. And I actually want to bring that learning forward. I think there is no business that doesn't benefit from having independent directors on the board of directors. I think there are few businesses that wouldn't benefit from having expert chief risk officer, an expert compliance officer, chief compliance officer. Few businesses wouldn't benefit from having a board with an audit committee and a nominating and governance committee, partially because these infrastructural corporate governance mechanisms are designed to mitigate conflicts of interest. They're designed to ensure that management acts in accordance with the expectations of those who are investing in the business. You mentioned due diligence earlier, and I just emphasize I'm here in Miami at an MFA conference, a Managed Funds Association conference focused on digital investing. And one of the things I talked about yesterday is investors and the necessity to effectively engage in due diligence, and where we see some failures in that context with respect to FTX. And I mentioned very specifically the Ontario Teachers Pension Fund, a public pension fund that invested $90 million in FTX, and shortly after FTX's bankruptcy last year had to write that investment down to zero. Due diligence applies in many contexts, and there are many ways that this kind of governance gatekeeping mechanism facilitates and ensures the integrity of the businesses that invest in, the businesses that operate in, the markets that we serve.
Commissioner, you've clearly been thinking through these issues very carefully. We thank you for your time. We got to wrap it there, though. That was CFTC Commissioner Kristin Johnson.